Hello everyone, my name is Brenda and today I'm going to deliver the cost accounting tutorial which covers the first week and the second week of the course. So, there are three main topics that we are going to talk about today. The first one is the difference between financial accounting and management accounting. The second one is cost terminologies and its purposes. And the last one, we're going to learn how to make a multiple step income statement. So, for the first topic, what are the differences between management accounting and financial accounting? Before that, we first have to know that cost accounting is part of management accounting. And the main difference between management accounting and financial accounting is the purpose of the information. For management accounting, the purpose is mainly to help managers make decisions to fulfill an organization's goals. Meanwhile, for financial accounting, the main objective is to communicate the organization's financial position to the external parties. And because of that, the primary users of this information is also different. For management accounting, it is mainly used by the managers of the organizations, and for financial accounting, it is mainly used by external users, such as investors, banks, regulators, and also suppliers. And also, because the different purposes, the focus of the information is different. In management accounting, the information is usually more future-oriented. For example, when we make budget for a yearly basis, and for financial accounting, because it aims to communicate financial position, the focus or the emphasis is usually past-oriented. And the standard is also different. In management accounting, there are no standardized standards such as GAAP, SAK in Indonesia, or IFRS, but it is more based on cost-benefit analysis, which means that the benefit that someone gets from the information in management accounting should exceed the cost that occurred when we obtained the information itself. Meanwhile, for financial accounting, there are many standards to make sure that the data are comparable, for example, GAAP and IFRS. And also, the time spent between the information is different. In management accounting, it highly depends on the decision makings that are going to be taken by the managers. So it varies from monthly to a long run, for example, 15 or 20 years. And for financial accounting, it is already standardized. Companies has to establish its report quarterly and also annually. And for the second topic, what are the cost terminologies in cost accounting? I divide this section into four groups. The first one is basic cost terminologies. The second one is direct cost versus indirect cost. The third one is variable cost versus fixed costs. And the last one is inventoriable cost versus period cost. So for the basic cost, what is cost? The definition of cost itself is everything that is sacrificed or foregone when we want to achieve a specific objectives. And there are two kinds of this. The first one is actual cost or a cost that has occurred, and also budgeted cost or a predicted cost. And we assign cost to something called cost object, which defined as anything for which a cost measurement is desired. And there are several examples of cost objects. For example, it can be product, service, project, activities, or even department in an organization. And in this course, mainly we will talk about product that is produced by a manufacturing company. And the second terminologies is cost accumulation and cost assignment. So cost accumulation is the collection of cost data in an organized way by means of an accounting system. So before we expense the cost, we do something called cost accumulation. And after that, we also do something called cost assignment, which is a general term that encompasses the gathering of accumulated costs to a cost object in two ways: tracing accumulated costs with a direct relationship to the cost object, and also allocating accumulated costs with an indirect relationship with a cost object. So the question next is, what is the definition of direct cost and indirect cost? Direct costs are costs that can be conveniently and economically traced to a cost object. So for example, if we think of a cost object of a car, the direct cost would be the parts of the car, because we can attribute the direct part into the car itself. And another example would be the labor that works specifically to manufacture the car. We can attribute the cost of the labor to the cost object, which is the car. And the second cost is indirect costs, which are costs that cannot be conveniently or economically traced to a cost object. So, for example, is the utility for a plant which produces both cars and motorcycle and also other transportation. We cannot attribute the cost of the utility conveniently and economically only to the cars. That's why it is called indirect cost. And why do these matter? Why do indirect costs and direct cost matters? Because uh, it affects how we assign the cost. For the direct cost, we trace the accumulated cost to the cost object. Meanwhile, for the indirect cost, we allocate the cost based on the cost driver to each of the cost object. And the third one of the cost terminologies is the cost behavior, which are variable costs versus fixed costs. So variable costs change in proportion with the output, meanwhile the cost per unit is unchanged. So for example, one car requires car parts that cost $3 per unit. Meanwhile, fixed costs are the costs that uh, doesn't affect the total dollars when the output or the level of production increase. So, because of that, the cost per unit also decrease when we increase our production. After understanding the direct cost, indirect cost, variable cost, and fixed cost, we can conclude that there are four kinds of cost. The first one is direct and variable cost, which means that the cost we can attribute directly to the cost object and also it increase as we increase the level of production. The example of this would be the tires used in assembly of automobile. And the second kind is the direct and fixed cost, which means we can attribute the cost directly to the cost object and it is not necessarily increase when we increase our production level. For example, the salary of supervisor of a car in an assembly line. And the third cost is indirect and variable cost, which means that we cannot attribute the cost directly to the cost objects, and it also increase when we increase the scale of the production. For example, is the power cost in an automobile plant. And the last one is indirect cost and fixed cost. So the cost cannot cannot be attributed to the cost object and it also doesn't change when we increase our production level. The example of this would be the lease cost or the rent cost of a plant. And the next one is inventoriable cost and period cost. So what is inventoriable cost? Inventoriable costs are costs that are considered assets in a company's balance sheet when the costs are incurred. And these costs are then expensed as cost of goods sold or COGS only when the product is sold. So for example, in a manufacturing company, the company has to buy raw materials and then it process the goods into finished goods. But sometimes the process is long enough so that we have something in between the process that is called work in process. And all the costs that incurred during the production of these three kinds, raw materials, work in process, and finished goods, are not expensed until the products are sold to the customer. So up until we get the revenue from the sales of the product, we have to account the cost as inventoriable cost, which means that it is considered as assets in the balance sheet of the company. And when we sell the product to the customer, which means when we achieve sales or we receive revenue, we then expense these costs as cost of goods sold. And the second one is period costs, which are the costs in the income statement other than COGS. And for the last topic, we will learn how to make a multiple step income statement. So as the name itself, the bottom line of this statement would be operating income. And there are three main components of this statement, which the first one is revenues, the second one is cost of goods sold, and the last one is operating cost. Or as we've talked about, the operating cost is the period cost. So it is always expense in the period when the cost is incurred. So let us walk through all of these components one by one. For revenues itself, the formula is price times the quantity of the item sold, which is usually already given in a problem statement. And the second one is cost of goods sold. There are several steps to make or to calculate the cost of goods sold. The first one is the beginning finished goods inventory, or the value of finished goods that we have in the beginning of the year. For example, it is $22,000, and then we also account the cost of goods manufactured, or in other words, the manufacturing cost uh, that incurred in the year, in the respective year. For example, it is 104, so the cost of goods available for sale would be 126. We got this from 22,000 plus 104,000. So we got 126,000 cost of goods available for sale in 2014. And we also, next is we account the ending finished goods inventory in December 31, which is the end of the year, which is $18,000 as an example. So we got the cost of goods sold $108,000. We have cost of goods available for sale for 126, and we subtract the ending finished goods inventory, which is 18,000. So we get 108 cost of goods sold. And revenues minus cost of goods sold, we will get gross margin, which is 102. And then we calculate the operating costs, which is R&D, design, marketing, distribution, and customer service costs, which is $70,000. So the total operating cost is 70, and we got the operating income by subtracting the operating cost from the gross margin. So 102 minus $70,000, we got the operating income $32,000. So if we look at this information, most of them are already usually given in the problem. But the question is, how do we calculate the cost of goods manufactured? Uh, that's why we also have to make the cost of goods manufactured schedule. And there are three main components of this statement. The first one is direct materials. The second one is direct manufacturing labors and manufacturing overhead costs. And the last one is the last step in which we calculate the cost of goods manufactured. So let me explain one by one. For the direct materials, we start with the beginning inventory that we have in the beginning of the year, which is January 1, 2014. We have $11,000 beginning inventory. And also in 2014, we purchased direct materials with the value of $73,000, which means that the cost direct materials available for use in the year is $84,000. What we have in the beginning, which is 11,000, plus what we buy during the course of the year, which is $73,000. It means we have $84,000. And then at the end of the year, the remaining inventory or the ending inventory is $8,000, which means that the direct materials that we used in 2014 is $76,000. And then the next component is direct manufacturing labor, which is usually already given in the problem statement. So it's 9,000. And we also have to account the manufacturing overhead costs, which usually are the indirect costs in the manufacturing process. So there are several kinds here. For example, the indirect manufacturing labor, supplies, heat, light, and power, and also depreciation. And the total manufacturing overhead, we just sum all these numbers, so we got $20,000 for that. And if we sum the direct materials used, direct manufacturing labor, and the manufacturing overhead cost, we will get the total manufacturing cost in 2014, which is 105,000. But this is not the final number that we are looking for, because we are looking for cost of goods manufactured. So we have to add the beginning work in process inventory, which is $6,000. So 105 plus 6,000, we will get total manufacturing cost to account for $111,000. And then we have to subtract the ending work in process inventory of $77,000. So we get the cost of goods manufactured in 2014, $104,000. So the logic here is that we got the manufacturing cost in 2014, and then we add the beginning work in process inventory in the beginning of the year, and then we subtract the ending work inventory. Thus, we get the number of cost of goods manufactured in the year. And then this number, 104, will go into the income statement to get the cost of goods available for sale. So beginning finished goods plus cost of goods manufactured, we will get cost of goods available for sale. So that is all the explanation of the materials, and we will continue into the tutorial section, which explains the exercises regarding these materials.